Title: The Sovereign Rollover Crisis, When Debt Meets the Gold Standard 2.0. Section 1. Introduction. The Age of Sovereign Refinancing. The world is entering an unprecedented refinancing cycle. Across the United States, Europe, Japan, and emerging markets, trillions of dollars in sovereign debt are maturing over the next 2 years. Refinancing is a normal feature of modern fiscal systems, but what makes this moment distinct is the convergence of three forces: higher interest rates, fractured geopolitical trust, and the migration of liquidity away from government bonds toward alternative assets like gold. The result is not a sudden crisis, but a slow and synchronized tightening, a sovereign rollover crisis unfolding in plain sight. Section 2. The Mechanics of Refinancing. How governments roll over debt. When a bond matures, governments rarely repay it outright. Instead, they issue new debt to retire the old, rolling it over. This perpetual refinancing works as long as two conditions hold: yields remain manageable and investors continue to buy. Today, both conditions are under pressure. The United States Treasury faces roughly $18 trillion in marketable debt maturing across 2025 and 2026, much of it issued during an era of near-zero rates. OECD governments, meanwhile, are expected to issue a record $17 trillion in 2025 alone, with nearly 80% of that serving purely to refinance existing obligations. Emerging markets add another layer of vulnerability, with an estimated $3 trillion in bond and loan redemptions through 2026. Debt is being rolled over into a higher rate world, meaning every maturity wall now compounds fiscal strain. What was once routine has become a structural test of trust. Section 3. Liquidity drain, where the buyers went. For decades, sovereign debt relied on an implicit buyer base: central banks, foreign reserve managers, and institutional investors seeking safe yield. That base is eroding. Quantitative tightening has reduced central bank absorption, while private funds face opportunity costs in an environment of sticky inflation and elevated equity returns. At the same time, global liquidity that once flowed into Treasuries is now being redirected toward bullion, commodities, and non-sovereign assets. Even as yields rise, the marginal demand for paper promises is thinning. The paradox is clear. Higher yields are meant to attract buyers, but in a system already saturated with debt, they merely signal stress. Section 4. The Gold Reawakening. Collateral over credit. Central banks have been quietly rewriting the playbook. For 3 consecutive years, they have collectively purchased over 1,000 tons of gold annually, marking the largest accumulation streak in modern history. Their motivations are diverse: sanction risk, diversification, and a search for assets free from counterparty exposure. But the message is unified. Trust in debt is being replaced by trust in collateral. Contrary to popular belief, gold has not been reclassified as a high-quality liquid asset under Basel III. Yet markets behave as if it has. Banks and sovereign funds treat bullion as a de facto reserve anchor, reflecting a shift from creditworthiness to asset-backed security. In a world of weaponized finance, gold's neutrality is its new yield. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5. Geopolitical catalysts: sanctions, tariffs, and energy wars. This monetary shift does not exist in isolation. It is entangled with a wider reconfiguration of global power. Sanctions and seizures. The freezing of roughly $300 billion in Russian reserves after the Ukraine invasion sent a shock through global central banks. The precedent was clear. Reserves held in foreign jurisdictions are only as safe as the politics that protect them. Trade retaliation. The United States has re-embraced tariffs as a geopolitical tool, seeking to compress trade deficits and protect domestic industries, further fragmenting the global trading system. China's strategy. Through its Belt and Road Network, China continues to promote gold settlement and bilateral currency swaps, gradually weaving an alternative trade architecture less dependent on the dollar. Energy and security. Europe's loss of cheap Russian energy has forced fiscal expansion and remilitarization under expensive debt, compounding refinancing pressures. Each of these forces drains liquidity, elevates risk premiums, and accelerates the search for real assets over political promises. Section 6. The feedback loop, rising yields and shrinking trust. The core dynamic of the sovereign rollover crisis is self-reinforcing. Rising yields increase the cost of refinancing, which amplifies fiscal deficits, which then require more borrowing. Investors demand higher returns to compensate for risk, driving yields higher still. Japan provides a clear example. After decades of yield suppression, its 10-year government bond now trades near 1.6%, the highest in over a generation. The yield rise was necessary to entice buyers, but it also marks the end of an era when money was effectively free. Similar pressures are emerging across the Eurozone, the United States, and emerging markets. The more expensive debt becomes, the more capital flees to collateral, chiefly gold, tightening liquidity further. The loop feeds on itself. Section 7. Systemic implications, a new reserve architecture. What is emerging is not a sudden collapse, but a structural evolution. The 20th century order was built on debt as money, government bonds functioning as both savings instruments and monetary collateral. The 21st may gradually shift toward collateral as money, where real assets, gold, commodities, even tokenized reserves, serve as the foundation of trust. This transition does not mean a return to the classical gold standard, but rather the rise of a multi-asset reserve system. Dollars for liquidity, gold for credibility, and digital settlement systems for efficiency. The BRICS bloc's diversification strategies, Europe's fiscal realignments, and America's tariff-backed industrial policy all reflect pieces of the same adaptation. Gold Standard 2.0 is not about pegging currencies. It is about anchoring trust in a multipolar world. Section 8, Conclusion. Trust, collateral, and the future of sovereign finance. The sovereign rollover crisis is not defined by defaults, but by diminishing belief in the ability to refinance indefinitely. The system is still functioning, but its foundations are shifting from debt sustained by faith to collateral sustained by scarcity. As governments roll trillions into higher yields and central banks hoard what cannot be printed, a quiet repricing of trust is underway. Whether this transition remains orderly or accelerates into rupture will depend on one question: can the world refinance itself without a reset?